$500 per ounce, gone in 72 hours. If you were long gold at 5,600, you just watched $20,000 evaporate from every 100 ounces you held. And for the leveraged traders, complete annihilation. This isn't a correction. This is a liquidation event. Gold crashed from $5,600 to $5,100 in less than 3 trading days. That's an 8.9% collapse in the world's supposed safe haven asset, the metal that's supposed to protect you when everything else burns. Let me put this in perspective. If you bought 100 ounces at the top, standard position for serious gold investors, you're down $25,000 right now, today. But here's where it gets brutal. The futures market. Traders running 10x, 20x, even 50x leverage on gold positions got obliterated. Margin calls flooded in. Forced liquidations triggered more selling. A cascading wave of destruction that fed on itself. Estimates suggest over $14 billion in leveraged gold positions were liquidated in the first 48 hours alone. $14 billion, wiped from existence. And the worst part? Most traders never saw it coming. So what happened? What triggered mass liquidations in gold? The one asset that's been screaming higher for months? One word: dollar. The US dollar index, the DXY, surged 2.1% in 36 hours. That might not sound like much, but in currency markets, that's a shockwave. The dollar strengthened against every major currency: the euro, the yen, the pound, the yuan. And when the dollar rallies hard and fast, gold dies. Here's why this matters. Gold is priced in dollars. When the dollar strengthens, it takes more foreign currency to buy the same amount of gold. That makes gold more expensive for international buyers. China, India, central banks, jewelers, industrial users, demand craters, price follows. But that's just mechanics. The real story is why the dollar exploded higher. 3 things happened simultaneously, and when they converged, gold didn't stand a chance. Number 1, the Federal Reserve shocked the market. On January 28th, the Fed released its latest policy statement, and buried in the language was a seismic shift. The market had been pricing in 3 rate cuts by the end of 2026. 3 cuts. That's what traders expected. That's what gold bulls were betting on. The Fed just signaled, maybe 1. Maybe. Jerome Powell's statement was clear. Inflation remains sticky. Core PCE is still running at 2.8%, well above their 2% target. Labor markets remain tight. Wage growth is persistent. Translation? The Fed is keeping rates higher for longer. And when real interest rates stay elevated, when you can get 4.5% on a treasury bond, the opportunity cost of holding gold becomes unbearable. Gold pays no yield, no dividend, no interest. It just sits there. So when safe treasury yields are high, investors rotate out of gold and into bonds. Capital flows reversed in 48 hours. The result? The dollar surged and gold collapsed. But that's just the first domino. Number 2, China stopped buying. For 18 consecutive months, the People's Bank of China had been accumulating gold every single month, building reserves, diversifying away from the dollar. Then, in late January, they went silent. China reported 0 gold purchases for the month. 0. After buying over 300 tons in the previous year and a half. Why does this matter? China is the world's largest gold buyer. When they step away from the market, a massive source of demand disappears overnight. And markets are forward-looking. Traders don't wait for the data to confirm. They front-run the move. But here's the deeper issue. China's economy is struggling. GDP growth is slowing. The real estate sector is in freefall. Youth unemployment is spiking. The yuan is under pressure. Beijing needs dollars, not gold. When your currency is weakening and your economy is fragile, you don't spend reserves on non-yielding assets. You defend your currency. You stabilize your markets. So China paused, and the gold market panicked. Estimates suggest Chinese buying was supporting gold prices by roughly $200 to $300 per ounce over the past year. When that bid disappeared, the floor collapsed. Overnight, the narrative shifted from China will buy forever to what if they start selling? Fear is a powerful accelerant in liquidation events. Number 3, the technical breakdown triggered algorithmic carnage. Gold had been in a parabolic rally. 5,200, 5,400, 5,600, vertical price action. euphoria, FOMO buying. But parabolic rallies don't end softly, they end violently. When gold broke below $5,400, a critical support level, every algorithmic trading system on Wall Street started dumping. High-frequency traders, momentum funds, commodity trading advisors running trend-following strategies. They don't care about fundamentals. They follow price. And when price breaks support, they sell aggressively. But the real massacre happened in the leveraged futures market. Gold futures allow traders to control 100 ounces of gold with just a fraction of the capital. A standard COMEX gold contract is worth over $500,000 at current prices. But you only need about $25,000 in margin to hold it. That's 20-to-1 leverage. When gold dropped 8.9%, leverage traders didn't just lose 8.9%, they lost everything. A trader long one contract at 5,600 just watched their $25,000 margin account get reduced to zero. Margin call, forced liquidation, account blown. And when thousands of leveraged positions hit margin calls simultaneously, brokers don't wait. They liquidate. Market orders at any price. That forced selling pushed gold even lower, which triggered more margin calls, which caused more liquidations. A death spiral. Open interest in gold futures, the number of outstanding contracts, dropped by over 40,000 contracts in 2 days. That's 4 million ounces of gold dumped onto the market in forced liquidations. The pain was indiscriminate. Retail traders, hedge funds, pension funds running commodity baskets. Everyone got hit. Let me give you a real scenario. Imagine you're a retail trader. You've been watching gold rally for months. You believe in the inflation hedge thesis. You believe the dollar is doomed. So in early January, you go long 2 gold futures contracts at $5,500. You put up $50,000 in margin. You're feeling confident. Gold hits 5,600. You're up $20,000 on paper. You're thinking about adding to the position. Then the Fed statement hits. The dollar surges. Gold drops to 5,400. You're now down $20,000. Your $50,000 margin account is down to $30,000. You get a margin call. You need to add funds or your broker will liquidate. You hesitate. You think it's just a pullback. You hold. Gold drops to 5,200. Now you're down $60,000. Your account is negative $10,000. Your broker force liquidates your position at 5,200. You don't just lose your $50,000. You owe the broker $10,000 more. And then, to add insult to injury, gold bounces to 5,300 the next day. This happened to thousands of traders in the last 72 hours. Fortunes destroyed, accounts wiped, years of savings gone. So where does gold go from here? Let me give you 3 scenarios. Scenario 1, the bear case. Gold drops to $4,800. If the dollar continues strengthening, if the Fed holds rates high, if China doesn't resume buying, gold could test the 4,800 level. That's another 6% downside from here. Support levels at 5,000 and 4,900 would break. More liquidations would follow. Probability? I'd say 30%. Scenario 2, the sideways grind. Gold consolidates between $5,000, $5,300. Markets digest the shock. The dollar stabilizes. Gold finds a base. We trade in a range for weeks, maybe months, while the market waits for the next catalyst. Probability, 50%. Scenario 3, the bull reversal. Gold reclaims $5,600 and pushes towards $6,000. This happens if inflation reaccelerates, if the Fed is forced to cut rates, if geopolitical tensions explode, if China resumes buying aggressively. Gold is still in a long-term bull market. The fundamentals, debt levels, deficits, money printing haven't changed. This could be a violent shakeout before the next leg higher. Probability, 20%. So what do you do right now? First, do not chase the crash. If you weren't already positioned in gold, don't try to catch a falling knife. Wait for stabilization. Wait for confirmation that the selling pressure has exhausted. Second, if you're holding physical gold, coins, bars, do nothing. Physical gold holders don't get margin calls. You're not leveraged. You're not forced to sell. If you believe in the long-term thesis, this is noise. Third, watch the dollar. The DXY is your leading indicator. If the dollar starts rolling over, gold will bounce. If the dollar keeps climbing, gold has further to fall. Fourth, Avoid leverage. The traders who got destroyed weren't wrong about gold's long-term direction. They were wrong about timing, and leverage punishes bad timing with total annihilation. Fifth, be patient. The best opportunities come after liquidation events, when fear is at peak levels. When everyone is convinced the trend is over, that's when you buy. Not now, not yet, but soon. Gold from 5,600 to 5,100. The dollar move that triggered mass liquidations. $25,000 per 100 ounces. Gone. 14 billion in leveraged positions. Liquidated. Thousands of traders. Wiped out. This is what happens when leverage meets volatility, when narrative meets reality, when hope meets the dollar. Markets don't care about your feelings. They don't care about your conviction. They care about capital flows, interest rates, and margin calls. Wealth doesn't disappear in events like this. It transfers from the emotional to the disciplined, from the leveraged to the patient, from the hopeful to the prepared. The question is, which side are you on? If this breakdown helped you understand what just happened and what might happen next, hit that like button. Subscribe for real financial analysis without the hype. And drop a comment. Are you buying this dip or waiting for lower prices? The next move in gold could define your portfolio for the next decade. Don't miss it.